Okay, welcome back everyone. Well, today's video is on the subject of bonds. So I think before we even get started on talking a little bit about bonds, I want to go back and a good place to start is to review the balance sheet. Now again, if you haven't watched the video on balance sheets yet, might be a good time to just go grab that video really quick and watch it. But essentially a balance sheet looks a little bit like this. And over here you have assets. Oops. Over here you have assets. Here you have liabilities. And down here is equity. Now, you've heard of stocks, no doubt, which are a little bit more common when you're talking about things to purchase as investments. But bonds are another form of investment that various kinds of institutions will issue. And, again, stocks belong down here because when you purchase a stock, you're really purchasing a part of the ownership or the equity in the business. Bonds, on the other hand, is a debt obligation of the institution. So a bond will be here, bonds, and is a liability of the institution. So you can see already the difference. A stock, again, is part of the ownership of the business or institution that's selling the stock. But here, a bond has no ownership rights at all. But it is an obligation of the company. Okay, obligation to pay. That's like any other liability that it might have. So that's kind of the key, beginning difference between a stock and a bond is where it sits on an organization's balance sheet. And again, this is the balance sheet that we're looking at. Okay, so there's another video out there on stocks, so take a look at that, and it gives you some general information about what stocks are beyond what we just talked about here. And so this video is going to tell you a little bit more about bonds. So now that you know where it sits on the balance sheet, let's talk a little bit about what it is. Again, it's debt of the issuer, and let's just say let's say that this balance sheet belongs to let's make it red. See what it actually looks like. Coca-Cola. So let's say that for our examples here today, we'll just say that this balance sheet belongs to Coca-Cola. So if Coca-Cola decides to sell some bonds to raise some money, and that's what bonds are for. Just like selling a stock, selling ownership in the business to raise money, selling a bond is also designed to raise money. It's just doing it a different way. It's selling it's selling a liability. It's selling a bond to someone, and then the company knows that it has to go pay that back. Whereas selling part of the ownership of the business, there's no obligation to repay anyone who owns stock. And so, but whoever's, but the company then loses a portion of its ownership because it's in essence transferring or selling some of its ownership to the purchaser of the stock. So again, so bonds are debt, so it's debt of the issuer, and in this case our issuer is Coca-Cola, right? It's Coke. And typically a bond has a maturity. In other words, it's not the issuer does not have to repay it typically for a period of at least 1 year. So most bonds have a maturity of at least greater than or equal to one year. And again, the purpose of selling bonds is to raise capital for the business. All right, and we'll talk about a couple of quick examples here. Now, who can issue bonds? Well, the most common issuers of bonds are the federal government, obviously U.S. government, states, counties, cities, and corporations. All right, now you'll notice one thing right off. These folks here Sorry, I was going to highlight that. These folks here are what? These are all government institutions. And contrasted, here this is a private business. So you can see that both government and private business can issue bonds. And you've probably heard about a government issuing bonds. This is typically how governments pay for a lot of things, whether it's a new school, maybe it's a new highway. Typically very large projects, but it can also include smaller projects. Maybe it's a water treatment plant. They will issue bonds. A lot of times they do it by way of vote of the citizens where they're located, and they'll issue those bonds to raise money to pay for these projects. And then over time, then the government will pay those bondholders back. Corporations issue bonds for the same reason. They need to raise money to build a new plant. Maybe it's to expand workforce. It might just even be just for regular operating capital. All right, so corporations have a variety of different reasons why they may need to raise money using bonds. Okay, so what happens when you purchase a bond? Well, let's just call this the what category. So when you purchase a bond, there's the bond. The bond pays interest to the bondholder, right? So that's going to be a percentage. And so you may purchase a bond that has a 6% interest rate. Oftentimes you'll hear it referred to as a coupon rate. And so every year you'll get, let's say you paid $100 for that bond. If it's a 6%, sorry about that. If it's a 6% bond, 6% coupon, then you'll get $6 per year for that for your investment until the bond is repaid. And then at maturity, and we'll talk about what that means in a minute, but the bondholder will repay the principal, which is your $100. So let's go through an example. You purchase a bond that is has a 3-year maturity and a 5% coupon and what they call a par value or a face value of $100. So let's just make it easy and say you actually pay that $100 for the bond in year 1. Then each year of these 3 years, you're going to get $5 in interest, right? So you get $5 in the first year, $5 in the second year, and $5 in the third year. So by the time this bond is maturing, you will have earned $15 in interest. And then at the end of that third year, the bondholder will pay you your $100 back in principal. So at the end of the whole process, you will have $115. Your $100 in principal plus $15 in interest over those 2 years, $5 per year. Okay, does that make sense? Okay, so let's see. We talked about rights early on, but basically bondholders have no ownership, so they don't control really anything as it relates to how the business operates. Stockholders have voting rights. Bondholders do not. Okay. However, bondholders have a larger claim on income and assets of the issuer. Now, what does that mean? Well, the obligation to pay your interest, let's change colors here. The obligation to pay your interest here comes before paying any dividends or anything to any of the stockholders. So this is really a priority. of the issuer, and it comes ahead of paying any dividends. So dividends would be down here, something that's paid to a stockholder. That really comes second. So claim on the income means that the interest payments that the issuer has to make has to be made before any dividends are made. When we talk about claim on assets, that's really the worst case scenario. If Coca-Cola goes out of business and they have to sell all their assets in order to basically pay its liabilities, that's normally what happens, right? So they're gonna go on the market and they're gonna sell their property and their plants and all of their equipment and other forms of property, and they're gonna sell those to repay all these liabilities over here, and your bond might be one of them. And so if there's only enough assets, let's say they have $100 in assets and $100 in debt, or all their liabilities over here. Well, if they sell their assets for $100, all of that's got to go to pay the liabilities, and the folks down here with the equity get nothing. Okay, so that's when they say there's a larger claim on assets. That's what this means. Again, the bondholders have a priority claim on assets. So at the time when the company, if it goes out of business and needs to sell, those bondholders will get paid first before the stockholders get paid. Okay. Okay, well, I think that's enough for this introductory video on bonds. There's much more to come, so check out Bonds 2, which will be coming, which should be up by the time you watch this video. So take a look at that to learn a lot more about some of these terms that we just went through and a whole bunch that we didn't. Okay, thank you very much. We'll see you in the next video.